Hello and welcome to Crossing the 49th, a cross-border tax and financial planning podcast. I'm your host, Phil Hogan, and today we have a very special episode for you. Today I'm joined by Brown and Doug Lawson of Hutcheson and Co, Chartered Accountants in Victoria, BC. Not only are Rob and Doug two of the best cross-border tax accountants in the business, they're also two of my very close friends. In this episode, we discuss offshore streamline IRS tax filing program, 1040X adjustments, RESPs and TFSAs for Americans, planning for Americans, moving to Canada, and much more. I hope you enjoy my conversation with Rob Brown and Doug Lawson. So I think a good place to start would be, of course, we all have, clients that, have U.S. tax filing requirements. But we also run into lots of new clients that have yet to file U.S. tax returns. They might have moved in from the U.S. To Canada, or they might be accidental Americans. And we had, the old school offshore voluntary disclosure program that we're familiar with. That's been some time ago. But this relatively new streamline program that we've seen a lot and we've helped many people with. So can you guys talk a little bit about the new streamline program and what you're seeing nowadays?
Sure. So the current program is the Streamline Foreign Offshore Procedures Program. This one is for U.S. citizens that are living abroad. And the scope of the filing essentially is the 3 years of old returns that are past their due date, as well as 6 years of FBARs, and a streamlined certification document, which outlines the facts of their situation, how they became non-compliant, and a little bit more details about their background. Now, this program is another iteration of previous programs. Back in the day, there's programs where you do 8 years of 8 years of taxes, 8 years of FBARs, and there's an FBI background check. And then lots of governments across the world, particularly in Canada, were pushing back, saying that these aren't real criminals, they're just people with complex situations that they're not fully aware of their filing requirements. So over the course of time, these programs have evolved. And the current program as it is now is 3 years of taxes, 6 years of FBARs, and a streamlined certification document outlining the facts of their specific situation.
Interesting. Now, do you find, like, when you're helping individuals with the streamline program, like, do you find that they're getting caught up and then continuing to comply, or are you finding, lots of clients are just renouncing after that process?
I think it varies based on the person. Lots of people have more ties to the States than others. For example, someone who's born in Canada to a parent who's a U.S. citizen, got U.S. citizenship at birth, lived in Canada their whole life, worked in Canada their whole life, and doesn't really have a lot of ties to the States except for, vacations and the odd, trip down there. And then we've got other people where, the former, they might be more inclined to renounce just to simplify their affairs. And the other group of people are people who born in the States, moved to Canada, built a life here in Canada. They still have ties potentially back in the States, like family, or more trips, or maybe they have assets in the States, less inclined to renounce. Renounce is a very personal thing. It's a very serious thing. And so it just depends on the person's set of circumstances.
Fair enough. So Rob, can we double click into that a little bit? So we know we have 3 years of tax returns. We have 6 years of FBARs, but like, what does that actually look like? So we have somebody that, that comes to you guys, has decided to kind of catch up with their returns. But technically, I'm assuming, assuming these individuals, they're Canadian tax, this is American living in Canada, let's say living in Victoria, their Canadian returns are compliant with. So what does that actually look like? So their Canadian returns are done and they come to you, like, what does that process actually look like?
Well, typically it's just an initial consultation that we'll do with them. And I usually like to point them just to the IRS website initially, there's a lot of really good information that they can get out of that.
Okay. Yeah.
So to give them a lot of background on it and also just the qualification for the program. We don't run into a lot of situations where people don't qualify, but I think it's important, right up front before you really get too far into actually the process, that everybody's really confident that they do qualify. It's non-willful. They're outside of the U.S. for the number of days that they need to be outside. They haven't been contacted by the IRS or any of that stuff. And once everybody's okay and comfortable that they're going to qualify for the program, it's really just sort of an initial consultation where we usually take a look at their returns on the Canadian side that they filed to kind of see what they look like, kind of walk through some of the compliance and possible other forms and what the U.S. tax returns are probably going to look like based on their Canadian returns. And we just kind of go from there.
So do you find, and I know, there's a spectrum here. One of the questions I get more often than not is, am I going to owe any U.S. tax if I'm going to catch up with my U.S. So can you guys talk about that a little bit? Like the situations where you might find a client would be in a position to owe U.S. tax, or where, in the more kind of vanilla situations, they wouldn't owe any U.S. tax at all?
Yeah, 99, maybe not 99%, but a big percentage of them don't end up owing any U.S. tax, especially if they've been living in Canada for most of their life, because their income's usually Canadian source, and our rates in Canada are generally quite a bit higher than the U.S. So they get that foreign tax credit on the U.S. return that essentially usually just credits out any U.S. tax.
If we're assuming that somebody's already quote unquote caught up, but they suspect that there's some errors on their tax return, because we see this a lot. We see, you might, American living in Canada, you have a Canadian accountant doing your Canadian return, you have a U.S. accountant doing your U.S. return, and in most cases, unless they're really, communicating properly with each other, there's almost always an issue, right? So what are some of the things you're seeing in terms of like making corrections to U.S. returns? Because I know it's something that we've done a lot of, but the actual corrections to U.S. returns, some of the more common issues you're seeing with U.S. returns having to be corrected for Americans living in Canada.
So some of the situations where we'll see discrepancies in the filings could be like on the Canadian return, we're reporting all your Canadian source income. On the U.S. return, we're reporting all your U.S. source income, and not being mindful that both jurisdictions require you to pay tax on worldwide income. So there's a discrepancy in there. There's also lots of considerations that are not taxable in Canada that would be taxable to the States that are omitted just because they might not be reflected on the individual's Canadian tax return. So for example, tax-free savings account income, it's not taxable to Canada, taxable to the States. There could also be a lifetime capital gains exemption that's not taxable to Canada, that's taxable to the States. Even property sales, where in the prior years, I think prior to 2017, there really wasn't a disclosure of the sale of a principal residence. And so you wouldn't really catch it unless, the accountant was able to identify a change in address or big balance in the FBAR. That would also be included on the U.S. return. And then any kind of regulatory disclosures, if someone, for example, has CPP, OAS, or U.S. Social Security, there's no treaty disclosure that's been included, or any kind of other forms that don't bear tax but are a regulatory compliance form that needs to be submitted with the documents.
Okay, yeah, fair enough. Now, of course, these are questions that I get very often from, new clients and existing clients. And I know, honestly, I think we have much more guidance now than we've ever had. But can we talk a little bit about TFSAs and RESPs? Once again, as you guys know, these are questions we get a ton. And I think, even a couple of years ago, we didn't have a lot of guidance from the IRS, because I know a lot of clients are they're asking for very specific guidance on how these things are treated for U.S. purposes. But until the IRS actually gives us this guidance, we're either guessing or we're trying to make our best guess on how the IRS is going to assess. Now, I know, a lot of not a lot, I should say, but some cross-border lawyers have written on RESPs and TFSA. So it sounds like there's a fair consensus in the community that these are not treated as foreign trusts. So if we just, for now, make that assumption that the TFSA and the RESP are not treated as foreign trusts, and we don't have 3520s, but what does that mean for U.S. reporting in terms of the income earned within the plans and how those should be reported for U.S. purposes?
I think back to Doug's point, that's something that we see a lot of the time that's missing from U.S. returns is these RESPs and TFSAs. Just very broadly, there's just so many forms and different types of disclosures and requirements on the U.S. side that's just often lots of the stuff that we see missing are all these different forms that get triggered just based on different tax structures or investments that people hold in Canada. But with respect to just RESPs and TFSAs, for RESPs, you're right that the IRS did sort of release a revenue procedure where they did provide some or I guess quite a bit of guidance on how they're going to treat RESPs and RDSPs, in that they're not going to require 3520s or 3520As for them. But what you do need to still do is report the income earned within those accounts. And for RESPs especially, you have the government grants and any sort of investment income. We typically like to also just include a disclosure with the return itself, sort of disclosing these accounts and how we're reporting them. So it is quite upfront and clear for the IRS if they do happen to look at the return and it's kind of all on the table how we're treating these and why we're treating them like that.
Okay. Yeah.
One thing you might run into. Oh, sorry. Go ahead.
Yeah. No. Go ahead.
I was just going to say the other thing you might run into with RESPs is that's one of the scenarios where we do see people sometimes end up owing some U.S. tax on their return because they might not have other passive income that's generating those passive foreign tax credits, and they end up unfortunately owing a little bit of U.S. tax sometimes because the income is reported on the U.S. return, but obviously not on the Canadian return. And so the same scenario with TFSAs.
Okay, yeah, because that's what I'm really finding is that you get to the point where these TFSA contribution limits tend to they're getting quite high, so they're quite appealing to people. And for those that, and not to get into the weeds here with 1116 credits, but if somebody does have a bunch of investment income and Canadian tax that they've accumulated, and let's say on their 1116 passive foreign tax credit carry forwards, they have a bunch of these carry forwards. Yeah. It does seem like it makes sense that you could, shove a bunch of capital into a TFSA and potentially not pay U.S. tax. Once again, that requires a fair amount of planning, but for some of those clients, that seems to be an option, assuming you don't have 3520 requirements, which would, be a reason maybe not to open up those accounts.
Yeah, and that's unfortunately an area where the IRS hasn't provided that revenue procedure or any guidance on how they're going to view those. I think you mentioned earlier there's some pretty prolific tax cross-border tax lawyers that have written about these, and I think their position is typically similar to the result with the RESP, where they're arguing that they're not going to be considered foreign trusts and require those nasty 3520s.
Sure.
So, we typically want to have that conversation with the client so that they kind of know the position that they might be taking, or the risks they might be taking on if they do have that TFSA. But if they do have other passive income, or even just having that TFSA with all that contribution room that is available now, it is definitely an appealing thing that we do see a lot of clients still maintain those and just are okay with the exposure and the risk that they might be undertaking with that.
No, fair enough. Doug, now what do you guys think? Now, I know this is fairly recent, and I'm gonna pull this up here. So there was a court case just recently, and if we look here, and I'm gonna pull this up on the screen. So yes, the United States Court, federal claims. So essentially, this was a court case that seemed to conclude that foreign tax credits could be offset or could offset NIIT, so net investment income tax, which is the, I guess at this point, a much older Obamacare tax that was meant to fund Obamacare. And in the past, this has always been tricky for us because we're, in cases where, a client might not owe U.S. tax, if they had excessive investment income, they would, they get assessed this NIIT tax that wouldn't be reduced by any foreign tax credits. Now, it seems like this court has said that NIIT potentially would be reduced by FTCs. Now, is that something you guys are discussing with clients? What are your thoughts on this new court case?
So the decision that came out on October 23rd for the French case, where they kind of looked at Article 24, which discusses the elimination of double taxation. That was between France and the United States, that tax convention there. We, Canada and the United States also has an Article 24. It's a provision in there to mitigate double taxation, where an individual is taxed by two taxing authorities. We'll see what happens. This ruling obviously is just fresh. We don't know if the U.S. is going to appeal it, but certainly depending on the individual and how much NIIT they paid over the past few years, it might be worth looking at the numbers to see, one, do they have additional passive credits that they could utilize? And then two, how big is the tax exposure to just make sure the lemon's worth the squeeze at the end of the day, not being accounting fees when there might not be a huge benefit. But it would be nice to see, what a response is going to be from the U.S. to see if there's going to be any pushback with an appeal. Because obviously, if the appeal gets approved and put through, then it doesn't really matter about this October 23rd. So we'll see. I think we still need to wait and see, and then maybe evaluate the clients most affected by this to see what opportunities there are looking back from the last few years.
Okay, that's all great stuff. Rob, can you just for the audience, can you just outline some situations where somebody might run into owing NIIT? Like, what are some common situations where they might not think that they would owe U.S. tax, but because of a transaction, they end up owing that net investment income tax on the U.S. side?
Just on that court case itself, I think it's definitely a positive step in the direction of potentially being able to avoid NIIT altogether, and potentially even go back and recover some of it. Is lots of the stuff that I've been reading. I don't think it's a slam dunk in the eyes of a lot of the stuff I've read, the way people are writing about it, but it's definitely a positive thing, because we do see a lot of situations where clients end up owing quite a bit of it. And I think the simplest example is just a large capital gain in 1 year where they're not really, they might be expecting the capital gain because they're selling something, but they're not expecting that because of that capital gain, all of a sudden they're going to end up paying potentially a whole bunch of U.S. tax on that.
Now that's because, although they paid Canadian tax on that capital gain, the tax on that capital gain is not going to be able to offset that net investment income tax over that threshold. That's the reason why they would end up paying it.
I think Doug mentioned that. Yeah, that's exactly the problem they run into. They offset everything up to the foreign tax credit line, but then there's that nasty NIIT line down below that they don't let you take any. Or I guess previously the understanding was there wasn't any ability to offset that with a foreign tax credit or anything else to get out of that. So it was just sort of a flat 3.8% that would end up just sort of showing up as a balance owing to the IRS that nobody really liked to see.
I really hope you're enjoying this episode so far. This podcast takes lots of time and energy to produce, and the best way to support our channel is to like, comment, and subscribe, and please share with friends and family who you think this would be interesting for. Thanks again for all your support, and enjoy the rest of the episode. Here, let's pivot a little bit here. It's, I think for the three of us, the clients that we probably speak to on a pretty regular basis are those that are either, moving to Canada or more specifically retiring to Canada. So those are often, you might have spouses coming back to Canada. You might have one, dual citizen, Canadian US and one American coming back through. Can you guys talk a little bit about what that planning looks like for these individuals returning or retiring to Canada? Because, we talk about this all the time where, in the office, specifically where, you might get somebody that's moved in June of 2022, and then they contact you in February of 2023. And because they're already here, a lot of that planning's moot. There's not much we can do. Yeah. So if you're speaking to somebody that's thinking of retiring through, what are some of the things that you're actually speaking to them about or potential planning items before you actually become a Canadian resident, again, from the US?
I generally will get them to prepare some kind of a net worth statement or a listing of their assets and what accounts are they held in, what structure is it under, so that I can go in and see how those assets will interact with the Canadian tax system to see if there's any adjustments that need to be made prior to their move. If they're already here, you can't really undo them entering Canada from a tax perspective, but if you can get ahead of it, and you can have an accountant look at your assets to see, are they efficient for tax purposes? Are they perceived in the same as in the States as they are in Canada? And just providing them with good guidance. Other things would be, making sure that the financial advisor can continue the relationship when they cease to be a resident of the United States, which I've seen can happen, and they have to move the investments. So it's always good to see what you're holding, how it impacts tax, what kind of things you need to rejig before you come to Canada.
Now, Doug, can you just talk a little bit about leaving a state? Because this is something I see, and we know this being often missed. When you're coming through to Canada, not only do you have new Canadian or, initial Canadian returns, part of your Canadian returns that you might need to file, and you're continuing to file your U.S. return, but leaving a state, what does it mean to kind of leave a state and become a non-resident of a state and now become a resident of Canada?
So when you leave a state, you'll have a special filing on your exit. So for example, if you're in California, you'll file something called a 540NR, which is basically you'll be taxable to the on your worldwide income to the state of California from January up until the day of your departure. And then going forward, you're only going to be taxable to the extent you've got California source income. And so the California return has a little bit more information that's required of you. And you also want to make sure that you're ticking all the boxes to make sure that you have appropriately exited the state for state tax purposes.
Fair enough. Okay, now that makes sense. Rob, can we chat a little bit about? We see this a lot, obviously. So individuals coming through, either moving to Canada or retiring through with LLC assets. And I know, of course, we can get into the weeds with this, but just from a high level, owning shares in an LLC, whether, with other partners or just individually, why is that an issue for new Canadian tax residents?
Well, I guess the main issue is just how Canada views an LLC versus the US. I think what's always really good for people to kind of understand what happens when they cross the border into another country like Canada or even into the US is, both countries design their own tax laws and neither one cares what the other one does. So,
sure.
So that's where a lot of this complexity always tends to come from. And with LLCs, that's a really good example where Canada, they view those as a corporation, and the IRS can consider those just sort of a flow through or a disregarded entity, depending on what it's categorized as, and that in itself just creates just a lot of unnecessary complexity and possible scenarios where there's double tax, where you're flowing the income out on their personal U.S. return, getting taxed in the U.S., but there's nothing happening on the Canadian side because they haven't distributed any of the money, so there's no tax or income being reported to Canada, but they've already paid tax to the U.S., and then they go to potentially distribute that money. Then there's tax in Canada, but maybe no tax in the U.S. So that's I think the simplest explanation of it. I don't know what you think about that, Phil, but that's usually how I've seen it happen.
Yeah, I mean, in most cases, it really doesn't make sense to maintain these assets, as you know, when you cross the border. So, I mean, for a lot of clients, we tend to plan out of these assets, whether we distribute assets, whether we sell the LLC shares, transfer them to a U.S. resident. You're right. It's just, it's a lot of extra effort that's likely not worth any benefit, if there is any benefit there at all. Rob, can you also just briefly touch on, because this is so common, we're seeing this all the time, clients come through with assets in their revocable trusts and what that means on the Canadian side?
I mean, that's a similar scenario to the LLC, where it's potentially just a flow through type of structure on the U.S. side, where the income just flows directly to the individual on their personal tax returns. And I mean, we even see, just because those revocable trusts are quite popular in the U.S., we see obviously investment accounts, and also even just their house they might have in a revocable trust, and that can cause quite a bit of headache on the Canadian side, because they're considered a trust for Canadian purposes, and now you're exposed to potential trust reporting in Canada and all the headaches that come with that. I think Doug touched on it when he was talking about people entering, where you really want to get ahead of all this stuff before you actually become a resident of Canada for tax purposes, or even in the U.S. You want to do the same sort of planning up front, and really getting somebody to look at all your assets and kind of what's going on overall, and sort of plan around. There's the tax efficiency that Doug talked about, and there's also a really important thing is just making it less complex for yourself when you're in Canada or in the U.S. If you bring up a lot of complex structures, or even perceivably simple structures, you can have just really, really nasty reporting on either side of the border.
Yeah, and that's a really good point. I mean, these structures are often set up and by professionals, and but it's not until somebody looks at them and asks the question, like what value is this actually providing? And and once again, maybe when the estate tax exemption in the U.S. was $1 million or $2 million, that made sense, but we're well north of 10 million at this point.
Yeah.
Not well, but maybe like 12 million at this point. The value of those revocable trusts, especially if you're a Canadian resident, probably doesn't make a ton of sense. And there's a ton of compliance and complexity with those structures. Doug, can we talk a little bit about Roth IRAs with respect to people moving to Canada? Of course, we don't have Canadian residents, even if they're American, open up Roth IRAs, but lots of individuals moving to Canada with Roth IRAs because they're very, very popular in the U.S. What do new Canadian residents want to think about with respect to their Roth IRAs?
So in your first year of filing as a resident, so say you enter in 2023, that 2023 tax filing will be due in 2024. They'll have to file a Roth IRA election to essentially prevent that from being taxable by Canada. There's a couple of rules with it as far as you can't contribute to it. Once you contribute to it while resident in Canada, then you kind of taint it, and therefore it becomes fully taxable and it loses its tax preferential status. So filing election is super important, and then not adding new money while resident. So if you're gonna rejig it inside, rebalance your portfolio inside, that's fine. But it's adding the new money, whether it's $1, 50 cents, or $10 million, it taints it at the end of the day, and therefore the benefit is gone.
Now, maybe Doug, you can speak to this too. Get this question all the time. Moved to Canada, haven't filed the Roth election. What are you finding from the competent authority in terms of sending in late? Now, I know you guys aren't filing late Roth elections. These are all for clients that have come to you for help after the fact, obviously. But like, what are you finding is the competent authority, are they still taking in these late Roth elections?
If you follow a few, there has been some guidance where they will accept late elections, and then the Roth it seems to be one of them. But I always premise that, there could be denied, but for the most part, we've been kind of given good guidance on it. So I would still file it.
Oh, okay. Rob, I'd like to chat a little bit about, once again, we see this all the time, the difference between having somebody, so you have a client that, they might have a Canadian accountant and then they have a separate US accountant, and then just kind of the interplay between those two. And I know the answer to this question, but why is it beneficial, and not from the accountant standpoint, but why is it beneficial from the client standpoint to have one firm do both the US and Canadian returns? Because I don't think it's very obvious to clients initially.
No, and I mean, look, we never want to take work away, or it's not to try to take anything from another account. It's just the back and forth that can be required to happen, especially if there's foreign tax credits flying into both countries. That interplay with the returns, just you need somebody, I think, working on the returns all at the same time. You can't kind of draft it up, send it to the other accountant, they add it into theirs, they send you their draft, and then you're updating yours. It's just that in itself is just a lot of back and forth and revisions and adjustments, and it's tough to really nail down the final foreign tax credits. So definitely from its simplicity standpoint, it's much simpler if there's just one accountant or one accounting firm that is doing both returns.
Okay, yeah, that makes a lot of sense. Now I know we're getting close to the end of our time here. What I'd like to finish with, and this is kind of peeling back the curtain a little bit, which I think is really valuable for clients. And we'll start with Doug here, and then we'll go to Rob. But Doug first. When clients are thinking about interacting with their, I'd say specifically their cross-border accountant before tax season, because we have some clients that kind of come in and they're in and out, before, let's say, mid-March. Some go all the way to October 15th. So what are some things you would say to clients that could kind of ease this? And I don't think there's a way to sugarcoat this. Tax season can be painful because there's a million things happening. We have, information getting thrown all around. We have changes to, tax rules, even in tax season. So what would you say to clients early in the season? What are some of the things they can do to really kind of ease the burden and get through tax season in the least painful amount of time?
I think having a good discussion with the accountant well ahead of tax time and just setting up expectations of the filing deadline and what's required of both parties. I think at the end of the day, if it's a new relationship between you and your accountant, it's always good to set, what specific information do I need to provide you? When can I provide it to you? When are the payment deadlines? When is my filing deadlines? Do we have to amend a Canadian return because that has to be filed first? And my K1 let me get in September. I think it's just good to have a nice conversation with your accountant to go over your situation, your filing timeline. Cost is certainly important, and what's required of you, and how best to provide that information to the accountant. I think those are pretty good steps. If you're thinking about planning, like the fall is a beautiful time. It's usually kind of after the busy season, after the accountants usually had a little bit of rest from the tax season and things like that, but it's before the close of the year. So, September, October, November are great months to reach out to the accountant to see, are there any planning opportunities that I should be considering before the end of the year so that they can be factored into my, 2023 tax filing, for example, things like that.
That's great. Yeah, I love that. Rob, so I would imagine, from my experience, you guys are probably sending out, a tax letter and a checklist probably end of Feb. So when clients are getting this information, what would you tell clients to really kind of lever and put their efforts into early to kind of ease that pain through tax time?
I mean, fill out Doug's checklist. He spends a lot of time.
There we go.
on that thing. No, I mean, really spend the time to read through the checklist, and fill it out as best you can. Organize your slips and your information, and the least amount of back and forth that we have, the easier it is, and ultimately the less expensive the overall filing ends up being. Have a look at last year, what you had. Our first place we start from is generally, what did they have last year, and do they have it this year? So that's a really good place for a client to start. Just take a look at last year's return and all the slips you had, and try to just make sure you have all the same stuff. And if you don't, it might be something you want to note on the control sheet the checklist as to why you don't have it. But really, the checklist that we kind of internally develop is pretty all encompassing. So it can be a lot for somebody to kind of read through, but it is there to help make the overall process as least painful as we can make it, I think.
Yeah, I think that's really important, because it's sometimes not very obvious that, obviously, most firms have hundreds and hundreds of clients, and as much, they certainly are our priority. I think it's surprising when I speak to people, they're surprised when I tell them how many tax returns actually get done in the last 2 weeks of April. And that's certainly not because we want to do that many tax returns in the last 2 weeks of April. It's a factor of, some of the last pieces of information come in the last couple of weeks of April. And it's not even, it's not the client's fault. They get these slips in the mail. So that's why I think it's really, really important for clients to, get that the first piece of information, the 90% of the stuff early on, so that last 10% can dribble in and get completed. So that's all great stuff. Really want to thank you guys. Where's the best place for clients to reach out and contact you to?
Directly through the website. Our emails are there. They can connect to us there, or simply just at my email, just rob@hutcheson.ca. It's probably the easiest way to reach out, and I can get back to you as soon as I can.
So same thing. So Doug at hutcheson.ca, and then the office phone 250-381-2400. Did I get that right? I think
that's right.
There we go. Okay.
True.
Really appreciate your guys' time, and really look forward to doing this again soon.
All right. Thanks, Phil.
All right. Thanks, guys.